Yes, so we start with the question for December 2021. December 2021, specifically go to question number 5. We are not doing the entire question, but there is something I want us we check here. December 2021, question number 5. And I'm saying we are not doing the entire question. Specifically, I want us we go to note number 3. To note number 3. Note number 3. Note number 3, in other terms, the addition information number 3. Addition information number 3. Addition information number 3. I hope you are there. If you are there, just confirm. Are you there? Are you there? If yes, just confirm. If yes, just confirm. If yes, just confirm. If yes, just confirm. Just confirm. Just confirm. Okay. So the question is, we are not doing the entire question. Specifically, I want us to go to the addition information number 3, and it reads, Bawabu Limited estimated that income tax provision for estimated an income tax provision of shillings 113.8 million is required for the year which ended 31st of March 2021. And then in the other paragraph, we are told the balance on the current tax in the trial balance represent over or under provision of the current tax for the year which ended 31st of March 2020. And then in the last paragraph, we are told as at 31st of March 2021, the tax base of Bawabu Limited net asset was shillings 292 million less than the carrying amount. And then you told the income tax rate of Bawabu Limited is 30%. So basically, remember with what we said, there is something I mentioned in our previous session, that this particular concept of income taxes, the examiner can bring an entire question whereby he is testing on issues to do with the deferred tax, or this particular concept of income taxes may be tested as part of some questions coming from a topic known as published financial statements, which now actually will be our next topic. So this particular question is basically it came from the topic of published. We have not yet done that, but specifically I want us to look on note number 3, because it's basically examining or tested what we discussed. So if you check on that particular note, we can go through that note again. We are told Bawabu Limited estimated an income tax provision of 13.8 million is required for the year which ended 31st of March 2021. Actually, the current financial year, if we go back to, can we go back to the first paragraph up there? The first paragraph up there, quickly. We are told that the following trial balance related to Bawabu Limited is at 31st of March 2021. So the current financial year was ending on 31st of March 2021. Going back to note number 3 in the first paragraph, we are told, or the first sentence, we are told, Bawabu Limited estimated an income tax provision of 113.8 million is required for the current year. That is the year which ended 31st of March 2021. So what are we given? I think we can just summarize that information here. So first of all, we are given what if that is the income tax provision, the income tax provision for the current year, which is 31st of March 2021, and we are told that this is the shillings 113.8 million. But if you check on the figures we are given in the trial balance up there, if you go back to the figures given in the trial balance, you'll be able to notice that those figures are given in thousands of shillings. For you to be consistent, it's always advisable you work with all your figures in thousands of shillings, because this 113.8 is given in million of shillings. So let's work with that figure in thousands of shillings, and it will be 113,800 in thousands of shillings. In thousands of shillings means that in this figure we have omitted 3 zeros. So this is the income tax provision. What is an income tax provision of a year? An income tax provision is basically an amount set aside by the company to pay the actual tax once it has been determined. So basically it means that during this particular financial year, the company estimated it was supposed to pay a tax of 113 800, and therefore this is the provision which the company will do what will make. The amount it will set aside from its profit to pay the actual tax. Let's go to the other paragraph of note number 3, and you're told the balance on the current tax in the trial balance represent other or over provision of the tax liability for the year which ended 31st of March 2022. 2022 is the previous year because the current year is 2021. So if we go back to the trial balance, we are told there is something called the current tax. Can you give me that particular item, that particular current tax which is given in the trial balance? How much is that particular amount? The current tax in the trial balance, anyone who can see that figure in the trial balance? There is an item called the current tax in the trial balance. How much is it? Current tax. Yes, so the current tax in the trial balance is 12,800. Now, what we are told is that this particular amount here is over, or basically is under, or over a provision, or over provision of tax for the year which ended 31st of March 2020. Now, in this case, you can see the examiner has not specified to us whether this particular amount here is over or other provision of current tax in the previous year. In this case, we say that it's upon you to know by basically checking whether that balance is a credit balance in the trial balance or a debit balance. Now, that 12,800, is it a debit or a credit balance? Is it appearing on the debit or the credit side of the trial balance? So in this case, it is appearing on the credit side of the trial balance. So if it is appearing on the credit side, is it over or under provision based on what we have discussed in our previous session? Is it over or under provision here? Yes, I'm told it is over provision. Recall we said that if you're given a current tax in the trial balance and you're told that is over or under, if it is appearing on the debit side of the trial balance, on the debit side of the trial balance, we said that this is under provision. If it is appearing on the credit side of the trial balance, then this is what? Over provision. That is now what you need to recall, that this particular amount here is what? Is over provision over current tax in the previous year. In the previous year. Now, what or how do we deal with this particular over provision? So over current tax in the previous year. So we said we take it forward to the following financial year. So this for 2020, we will take it to the year 2021. And in this case, we said an over provision. Do we add it? Do we deduct it from the current year's estimated tax liability? So this particular over provision, are we supposed to add it? Are we supposed to deduct it from this provision for the current year? Are we supposed to add it or deduct it? Yes, in this case, that is very much correct. We said once we take it to the following financial year, what do? We deduct it from the estimated tax liability for the following financial year, for us now to be able to determine the amount of provision which will be created during the current year. So I think maybe first of all, we can compute that. We can compute what if is the current tax provision, the current tax provision for the current financial year, current tax provision for the current financial year, current tax provision for the current year. The current year in our case is the year which ended 31st of March 2021. How do we determine this? We determine this by taking this figure here, that is the estimated tax provision, because we are told this is an estimated for the current year, the year which ended 31st of March 2021, which is basically a figure of 13,800. And then to this, we are saying we do what? We less the over provision of a provision of a current tax, over provision of current tax in the previous year, which is the year which ended 31st of March 2021. Sorry, 2020. And in our case, it is a figure of this 113, recall 113,800. So we less this particular over provision, which is 12,800. And in this case, we will get a figure of what? Yes, I'm told by Margaret. Here we are going to get a figure of what? Of 101,000. 101,000. 101,000. I hope the rest are getting the same. 101,000. So this particular 101,000, this is the amount we are going to charge in the income statement. To charge in the income statement means that when preparing the income statement, once we have gotten the profit before tax, we are going to less two types of taxes. We are going to less the current tax of how much? 101. And then here we also need to determine something else called deferred tax. So, and for us to determine the deferred tax, I want us to go to the last sentence of note number 3, the last paragraph of note number 3. What are we told in the last paragraph of note number 3? We are told that as at 31st of March 2021, which is now the end of the current financial year, the tax base of Babu Limited net asset was 292 million less than the carrying amount. And then you're told the income tax rate was 30%. So we are given the difference between tax base. We are given the difference between tax base and carrying amount. So what is the name given to this? The difference between tax base and carrying amount. So who can be able to remember the name given to the difference between tax base and carrying amount? What do we refer to the difference? The name given to the difference between carrying amount and tax base of net asset. Net asset is basically asset minus liabilities. Yes, so the difference between, recall, we defined a number of terms in our previous session. One of the terms we defined is temporary difference. And actually we say temporary difference. This is the difference between a tax base, or basically between carrying amount and what? Tax base of asset and liability. So the figure which you're given here, 292 million, this is the temporary difference. And actually that information now we are going to use it in computing the deferred tax. So first of all, we are given a figure of 292,000. So we work with our figures in thousands of shillings, and we are told that at the end of the year, the tax base, okay, we can just put it like this. We are told that the tax base was, or that is tax base of Babu Limited net asset was 292 million less than carrying amount. This one was less than carrying amount, with an amount of how much? 292,000. So what basically we need to do, first of all, is a temporary difference. That is something we have already agreed upon. So, but if you can be able to recall, we said that we have two types of temporary differences. We have taxable temporary difference. We have deductible temporary difference. So what we need to do is to determine, is this a taxable or a deductible temporary difference? For you to be able to do that, you have to recall what we said. We said a temporary difference is taxable if the carrying amount of the asset or basically liabilities is more than tax base. So in that case, the temporary difference is taxable. But on the other hand, we said if the carrying amount is less than tax base, then that is deductible temporary difference. So in our case, we can see, we are told the tax base is less than carrying amount. I think for us to be able to know whether this is taxable or deductible, let's start with the carrying amount here. So if we start with the carrying amount, what are we going to do? We need to change this inequality sign. It is less than. So if we start with carrying amount, automatically this becomes what? Greater than. I hope you can remember this is something you are doing in high school, in those mathematics of what? Inequalities and so on. Yes, so we start with the carrying amount, we change our inequality sign to be greater than. So therefore you can say carrying amount is greater than tax base with an amount of how much? 292,000. Now having that, you need to tell me this particular temporary difference as per what we have discussed here. Is it taxable? Is it deductible? Is it taxable? Is it deductible? Who can tell us here? Is it taxable? Is it deductible? Because we can see carrying amount is more than tax base. It basically means that this is a taxable temporary difference. So equally, recall something, and we also discussed in our previous session, a taxable temporary difference. This we said give rise to amount which will be taxable in the future, amount which will be taxable in the future, or in other terms, we said a taxable temporary difference give rise to something called a deferred tax liability, taxes which will be payable in the future. On the other hand, we said deductible temporary difference. This will give rise to amount which are deductible or allowable in the future, and therefore we say that this give rise to something called a deferred tax asset. And because in our case we have a taxable temporary difference, what do we need to compute? Using this taxable temporary difference, we need to compute something called a deferred tax liability. So how do we compute this deferred tax liability at the end of the year? So at the end of the year, that is on 31st of March 2021. So to compute this one, we take our taxable temporary difference, which we have here, and then we multiply that with the tax rate, And that's why in that case, we are given in the last paragraph of note number 3, we are given the tax rate. So we have the taxable temporary difference, which is 292,000 times the tax rate, which is 30%, So this now will be the deferred tax liability at the end of the year. So how much is our deferred tax liability at the end of the year? Our deferred tax liability at the end of the year, how much here? 30% of 292,000. 30% of 292,000. That will give us what? That I'm told by Margaret here. It will give us 87,600. Now this particular 87,600, it is a deferred tax liability at the end of the year. So how should it be recognized in the statement of financial position? So this one, the deferred tax liability, when the company is preparing the statement of financial position, this one is recognized as an non-current liability. So this one represents the taxes the company will be required to pay in the future. It is a non-current liability. It is a non-current what? Liability. But also, there is something we need to do. We need to compute the amount of deferred tax to be charged in the income statement. Because recall what we said is that income tax which is charged in the income statement, this comprises of two components of tax. The current tax, we have already computed the current tax to be charged in the income statement, and also this comprises of something called the deferred tax. So the deferred tax which is charged in the income statement is known as either deferred tax expense or a deferred tax income. So it is not this amount because these are liability. A liability is supposed to be recognized in the statement of financial position. So how do we determine this particular amount of deferred tax to be charged in the income statement? The amount of deferred tax expense or income to be charged in the income statement. To be charged in the income statement here. For us to determine that, just a minute, I don't know what is happening with my camera here. Okay, so just give me a minute. My camera is misbehaving. Just a minute. Continue. Yes, so what I've said is that what we need to do, first of all, we have determined the deferred tax liability. We are saying this deferred tax liability when the company is preparing the statement of financial position is an non-current liability in the statement of financial position, but we want to determine the amount of deferred tax expense or income to be charged in the income statement. How do we do that? We do that by preparing an account which is called deferred tax account. We prepare an account called the deferred tax account, deferred tax account. So basically, these are ledger accounts. A ledger account should have a debit and also a credit side. So, and what do we start by recording in this particular account here? So if you go back to the trial balance, you'll be able to see something called the deferred tax. So can you go back to the trial balance and you tell me, can you see something called the deferred tax? In the trial balance, there is something called the deferred tax. Can you see that? The deferred tax in the trial balance? How much is the deferred tax in the trial balance? The deferred tax in the trial balance. How much is it? I can see that figure just above where we had current tax. Above that, we have payables. Above that, we have deferred tax of how much? Of 97,600. Now, who can tell us that particular amount of deferred tax? Is it a deferred tax income? Sorry, is it a deferred tax asset? Is it a deferred tax liability? Who can tell us? Is it a deferred tax asset? Is it a deferred tax liability? Someone is saying is an asset. Someone is Isaac Stella saying that this is an asset. Naomi is saying is an asset. Elizabeth is saying is an income, liability. What is this? It can only be a deferred tax asset or a liability. It can either be a deferred tax asset or liability. So those who are telling me that these are deferred tax assets can't be able to can't recall this acronym which I gave you here. You can't recall this particular acronym which I gave you here. Remember, this acronym is very, very important in financial reporting. DIRA. DIRA, we said these, for example, stand for drawings in a company. We may not have necessarily have drawings. E stand for expenses. A stand for assets. You have to remember this. And actually, we said all these items, they have a debit balance. So if for example, that item of 97,600 is on the credit side, then you can't tell me it's an asset. There is no single time you can have an asset on the credit side of the trial balance. Then we said L here stand for liabilities, this stand for equity, which is capital and reserve, this stand for revenue or incomes. We said all these items in the credit in the trial balance, they have a credit what? They have a credit balance. So therefore, because that item, the examiner not tell you, is upon you to know. Is upon you to know, because the examiner expects you to know that assets, they appear on the debit column, liabilities, they appear on the credit column. So therefore, that is a liability. So that is a deferred tax liability. So being a deferred tax liability, remember these are the account. So we need to record that as an opening balance. And actually, that is the deferred tax liability at the start, because whatever you have here is a deferred tax liability at the end of there. Now, when preparing this account, which side do we record it? Do we record it on the debit or the credit side? Who can tell us? As the opening balance here, do we record it on the debit side or on the credit side? This is something which you have to recall from what you did in financial accounting. Esther is also saying we record it on the debit. Teres, that is also very long. Victor on the debit, very long. So all liabilities, just like what you have said here, all liabilities, they have a credit balance. So when recording a liability, you record it on this side. The opening balance should be on this side, is a liability. But if it was an asset, all assets, they have a debit balance. So that figure is how much? 97,600. So that is the opening balance which we have. Then the other item we also have, as far as this account is concerned, is this deferred tax liability at the end. At the end. So now a deferred tax liability at the end of the year, we record it down here as a balance carried down. I hope you can see why we are recording it, and why do we record it on the debit side? Yet we are saying liability should be recorded on the credit side. The reason why we are adjusting, or basically we are recording that on that particular side there, that is on the debit side. We're recording it on the debit side there, and actually as a balance carried down here, is such that once we have balanced our account, we have to bring down this balance here. I hope you can remember the rules of balancing ledger accounts. So we bring it down. So this will be balance brought down, and actually you can see it will be on the credit what side. This is the balance which you transfer to the trial balance. When after balancing a ledger account, you have a balance carried down, you bring it down, you have a balance brought down, and it should be a credit balance. You transfer it to the trial balance as a credit balance, as a credit what balance. So after recording the opening, the credit, the closing balance, what you do, you balance your account. You can have a balancing figure on this side. If you have a balancing figure on this side, this is known as a deferred tax expense. You may have a balancing figure on this side. You take it to the income statement. A balancing figure on this side is known as a deferred tax income. A deferred tax what? Income. Basically, that's how now you determine the amount of deferred tax to be charged in the income what? statement. So this side is more 90 what? 97,600. 97,600. So mean that the balancing figure is basically on this side, which is 10,000, which is 10,000. And what is that? That is a deferred tax income. Is a deferred tax income. Is a deferred tax income. Now, having done that, now when preparing the income statement, or basically what you refer is a statement of a profit or loss. Statement of profit or loss. So how do you deal with this particular taxes which you have computed here? How do you deal with these particular taxes? So remember, these are just, we are not preparing the entire income statement. This is just an extract. This part of the income statement, we want to show how should the company account for these two components of taxes. So after getting the profit before tax, and actually we're going to do this particular question in our next topic, which will be the topic of published. So after getting the profit before tax, which we don't have, you come here and you less now the income tax expense. The income tax expense. Now, the income tax, recall in our previous class, we said we have two types of income taxes. Two types of income taxes. Which are those two types of income taxes? One of it is the current tax. And in our case, we have already computed the current tax to be charged in the income statement. This is the current tax to be charged in the income statement, and that is the figure we have computed here, which we said is equal to the estimated tax liability for the current financial year, and then you have to adjust that with other all over provision of current tax from the previous year. So the current tax is this one. So this one is a current tax, is a provision. So is money which will be set aside from this profit. You less it there. And then the other type, or the income tax, also comprises of deferred tax. But what we have here is a deferred tax expense. If it is an expense, you less it here. You less it here. But in our case, do we have an expense? No. We have a deferred tax income. So a deferred tax income of 10,000, because it's an income, you do what? You add it. You add it to your profit here. You add it. But if it was a deferred tax expense, but you can't have both. You can't have both at the same time. You can have either deferred tax income or expense. And income, you do what? You add it. You do what? You add it. And then from there, you basically get now the profit after tax. The profit after what? Tax, which equally we can't be able to do what? To determine. So therefore, you can see that particular note there. It was basically testing on the concept of what? Of the deferred tax. On the concept of the deferred tax. Yes. So that is it. That basically what was required as far as that question here is concerned. So maybe we will still come across so many questions similar to this, because in our next topic, I'm saying we are looking on the topic of published, on the topic of a published financial statement. So next, I want us to look on another question on this, which was basically a full question testing on what? On the still income taxes. So I hope you have understood what you have done, but no worries. If you have not understood in our next topic, the topic of published, I've said we are going to do that question for December 2021 as one of our illustration questions. We will still do that, the same workings, so that maybe those who have not understood what you have done, you'll be able to do that. So let's go to this particular question here. This particular question here, I think this one is for which sitting? This one I think should be April 2023, which is question number 5. Question number 5, and so the entire question was on was testing on this standard IS 12. IS 12, April 2023. April 2023. Are you there? Are you there? Are you there? I want us we do the part B. I'll be able to share the solution for part A. Part A was a theory. Part A, you can see it was requiring you distinguish between taxable, temporary difference, deductible. This is something you did, but Roman 2 and Roman 3, I'll be able to summarize some the solution for the same, and I share that with you. So can you confirm whether part B is for a company called BXL Manufacturers Limited? Is that the question? Yes. So let's go through that. Let's go through that particular question there. I hope you're there. So the question is, BXL Manufacturers Limited, a small firm engaged in the production of fertilizer, purchased an item of equipment for shillings 12 million on 1st of July 2018. The company provided depreciation on equipment on a straight line basis at the rate of 25% per annum. So, and then you're told during the 4 years, from 1st July 2018 to 30th of June 2022, the profit after tax and the allowed wear and tear charges for tax purpose were as follows. So we're given now the periods. Basically, these are the years. We have the first period, which started on 1st April 2018 to 30th of June 2019, up to the last period of the last year, which started on 1st July 2021 and ended on 30th of June 2022. And then we have the profit after tax, the profit after tax, and then you're given something called the allowable wear and tear charges. So, and then you're told the corporate tax for the year, for the period of 4 years was estimated to be at the rate of 30%. So what are we required to do? We're required to compute for each of the years which ended 30th of June 2019, 2020, 2021, 2022, Roman 1, the taxable profit, and number 2, we are required to compute something called the deferred tax. Now, first of all, even before we answer the Roman 1 and Roman 2, so this question was basically a repetition of another question which was examined some time back, and it had a small error. So the profit which you're given there should be profit before tax. If the examiner wants you to compute the taxable profit, for example, as required in Roman 1, you can't be given profit after tax. You can't be given the profit after tax. So you can only be given profit before what? Tax, which is known as the accounting profit. Because for you to compute this profit here, which is known as the taxable profit, this is something basically you'll be able to see in taxation. So you have to be given something called the accounting profit. What is accounting profit? Accounting profit, in other terms, we said that is the profit before tax. So therefore, that question had a small error. That profit should be not be profit after tax, should be accounting profit or profit before tax. So therefore, if you have the physical paper, maybe you need to change that to be profit before what? Tax. And let's start with Roman 1. Let's start by answering Roman 1, whereby we are required to compute the taxable profit. Remember, in this case, we said the taxable profit. Basically, this is a profit which the company uses in computing the actual tax. In computing the actual what? Tax. Now, how do we compute this profit? How do we compute this profit? The taxable profit. So to compute this one, what we do using the information which is provided in our question, we take the accounting profit. We take the accounting profit. The accounting profit, which you're saying is the same with the profit before tax. So that's why I'm saying that question had a small error. That profit was supposed to be profit before tax, not after tax. Now, to this accounting profit or profit before tax, so what we do is that we add back the disallowable expenses, disallowable expenses, which were deducted in arriving at this profit. So as per this particular question, we only have one disallowable expense. And remember, there is something explained as far as this is concerned. We said disallowable expenses. These are those particular expenses which the taxman will not allow you deduct from your incomes when computing the taxable profit. There are those particular expenses of your business which the taxman will not allow you to do what? To deduct from your incomes in determining the amount of taxable what? Profit. So therefore, we add back the desirable expense. In our question, we only have one, which is depreciation. And then now to this, what do we do? To this, then we less the allowable expenses. So these are those particular expenses in accordance with the tax laws should be deducted from your from the incomes of the business in computing the taxable profit. So we less the allowable expenses which were not deducted in arriving at this profit, and the allowable expenses which we have in our question here is now what is known as the wear and tear charges. The wear and tear charges. And actually I said that this is something you'll do in taxation. For those who have not done taxation, you'll do this in PFT, but maybe for those who have done PFT, basically knows very well that if, for example, you have a business and maybe you have invested in an asset like a building, you have invested in an asset like a motor vehicle, and then because the taxman wants to encourage people to come and invest in businesses, so the cost you have incurred is basically supposed to be offset. So it's supposed to be deducted in your incomes when determining the taxable profit. But now, in terms of how you deduct that cost you incurred from your incomes, you need to use the tax laws issued by the taxman. It's not upon you to determine that, for example, if you have incurred a cost of 2 million in a certain year, you're going to deduct the entire 2 million from your income. No, it's the taxman who dictates how to deduct that from your income. And basically the amount you deduct from your incomes and which is computed in accordance with the tax laws, we refer to that as capital allowance or the wear and tear charges. So basically this is how we compute now the taxable profit. So therefore, for us to do that, because you can see we are required to compute this for a number of years, actually for like 4 years. So we are going to have those columns here, 2019. We're going to have the first year here, which is 2019, 2020, 2021, 2022. And also, if you check on the figures we're given for the profit before tax, you can see those figures are in thousands of shillings, like that. Are in thousands of shillings. So therefore, we are required to compute this taxable profit. How are we going to compute this? We start by taking the accounting profit. The accounting profit, which I've said is the profit before tax. And don't ask where we're getting this profit before tax. I've said that profit before which are given here there as profit after tax, that was an error. It should be accounting profit or profit before tax. So therefore, we have said if you have the physical paper, just need to change that. So we have 24, we have 27, we have 2850, and then 2550. So basically, remember, it is obvious that some questions which have been tested in the past, some questions do have errors, but anytime a question has an error, so those who mark automatically know how to navigate. How are they going to mark that particular question, taking into account it had an error? Sasa, yes, it is obvious that a question may have an error. Yes, so that is what we start with, profit before tax. Then to this, what do? We add back desirable expenses. Which expenses are we adding back? Is depreciation, because we know in arriving at this accounting profit, the company has already deducted depreciation on that asset, because I hope you can remember you told the company acquired an asset. So that depreciation we have said is desirable expense. When computing your taxable profit, the taxman will not allow you to deduct that from your income. So we add back the depreciation of the asset. So we are given the information on how this asset is to be depreciated. Let's go back to paragraph 1 of this question. We are told that 𝐵XL Limited, a small firm, engaged in production of fertilizer purchased an item of equipment. This is an asset. An item of equipment at a cost of 12 million on 1st July 2018. 1st July 2018 is the start of the first year here. The start of the first year. And then you're told the company provide depreciation on equipment on straight line basis at the rate of 25% per annum. So this equipment is depreciated at the rate of 25% per annum on straight line. On straight line, we compute depreciation based on the cost. What is the cost of our equipment here? It is 12 million. But recall, in our case, we are working with our figures in thousands of shillings. So we take it as 12,000. So what will be 25% of that, which is now the depreciation per annum? And it will not change over the period of 4 years because the company is using straight line. At a straight line, the depreciation remains the same. In year 1, year 2, year 3, depreciation is computed based on cost. So the depreciation here per annum is 3,000 like that. So we have added back depreciation. Why have we added that? Is because it was deducted in arriving at this profit, but we know we have said that this is disallowable or non-deductible expense. So when computing the taxable profit, this should not be deducted from the incomes of what? Of the business. That's why we are adding it back. And then from there, what do? We less wear and tear charges or capital allowances. Why are we deducting this? We are deducting this because in computing this accounting profit or the profit before tax, so the company do not deduct capital allowance. The company deducts depreciation, but depreciation is not allowable. So what we do, add back depreciation and then less what is allowable. So I remember I've explained what is this. Yes. So we less, we less the wear and tear charges. Wear and tear charges. This is something you'll be able to discuss in details in PFT taxation. Yes. How do we compute this? Under paragraph 1, we are given the rate of computing wear and tear charges. So in the first year, it should be 40% on cost. Year 2, 30% on cost. Year 3, 20% on cost. Year 4, 10% on cost. And this should be cost of the asset. Cost of the asset, remember, is 12,000. So in year 1, it should be 40% of 12,000. Year 2, 30% of 12,000. Year 3, 20% of the cost, which is 12,000. And the last year, which is year 4, 10% of this 12,000. So this should give us 48. So we less it from this. The other one will be 36. Year 4 will be 24. And year 5 will be what? Will be 12. Yes. So then from there, what do? We get the taxable profit. We get the taxable profit. We get the taxable profit here. The taxable profit. So the taxable profit in the first year will be what? What will be the taxable profit here? The taxable profit, I'm told, no, it can't be 6,000, Victor. We have this 24. Oh, it's 600, eh? Okay, yes. 600. What about year 2? It is what? 20? 21? Yes, 21. Then 2021 is what? 3450. And then finally, what do we have here? In the year 2022, it will be 43 what? 43.50. Yes. So that is basically the taxable profit. Assuming in this question equally, because this is something also the examiner may require you to compute. Assuming you are required to compute current tax, you have now to recall how do we compute the current tax? Because you may come across a question whereby the examiner is requiring to compute this. To compute this current tax, we said we take the taxable profit times the tax rate. Taxable profit times the tax rate. So remember, you already have the taxable profit here. So we just need to multiply that with the tax rate. In the last paragraph of that question, you're told the corporation tax for the period of 4 years was 30%. So if you're required to compute this current tax, you just need to get 30% of the taxable profit. So for example, in the first year here, 30% of this will give us what? 180. In this year, 30% would be what? Will be 6 what? 30. So what about here? 30% of this will give us what? 30% of this will give us what? 13 what? 13 what? That is 10 for 13 or 5. What about 30% of this? 43.50. 30% of that will be what? Will be what? 30% of this. 30% of 43.50. 13.50. So this one was this was 10.35. Okay, 10.35 like that. So that is something which the examiner will be required to compute. But in that question, what was required is this one. So and basically these and actually the items I think which were marked in that particular question take into account this particular profit had a problem. So that is it. Let's move to Roman 2. In Roman 2, what are we required to do? We're required to compute the deferred tax. Now recall, in our previous session, we said that there are two approaches which can be used by the company in computing the current tax, in computing the deferred tax, So two approaches. We have something called the income statement approach, whereby we compute the deferred tax using the timing difference. Timing difference, we said, is the difference between accounting profit and taxable profit, which give rise to deferred tax. For example, if you check on what we have here, we have the accounting profit because we are saying this accounting profit, and then we have the taxable profit. Now, if you check on these two profits, you compare these two profits, can you see the two profits are different? Can you see the two profits are different? Yes. And actually what we said is that if the accounting profit and taxable profit are different, that will give rise to deferred tax. So therefore, we may decide to compute the deferred tax using the timing difference, the difference between this and this. So, and actually you can see the difference here is how much? The difference here is around 18, is 1800. So now what causes this difference between these two profits? The cause of the difference is the difference between depreciation and wear and tear charges. Because in computing the accounting profit, we use depreciation. In computing taxable profit, we use capital allowance or wear and tear charges. We may decide to use that approach, the income statement approach. Number two, we said that deferred tax can also be computed using the balance sheet approach. Under the balance sheet approach, we compute the deferred tax using the temporary difference. Temporary difference is what? Is the difference between carrying amount and the tax base. And therefore, in this question, what I want us to do, I want us to use that approach number two, balance sheet approach, because we said that is the method which is recommended. That is the method which is recommended. So we are required to compute the deferred tax. We are required to compute the deferred tax. The deferred tax. And in this case, we are going to compute this using which approach? I've said we use the balance sheet approach. So under the balance sheet approach, we compute the deferred tax using the temporary difference. Remember, in our case here, we have a number of years. So what we are going to do here, we're going to have basically a number of years here, 2019 to 2022, 2020, 2021, 2022. And here we need to compute the temporary differences. What is temporary difference? You have to recall temporary difference. This is the difference between carrying amount and tax base. Carrying amount and tax base. Now here we only have single asset. A single asset. What will be the carrying amount? Now when the company is preparing the balance sheet, the statement of financial position, this particular asset which was acquired here, that is the equipment, it should be recorded in the statement of financial position with which value? Who can tell us? Take into account it is being depreciated. So generally, the name for that value, is what? The name for that value, the value at which an asset is recorded in the statement of financial position, especially assets which are depreciated. Yes, I'm told by Anna is net book value. Is that correct? Yes, that is very much correct. So this particular asset will be recorded in the statement of financial position, which is the carrying amount at the net book what value. So therefore, the carrying amount of this asset is the net book value. Now, what is the tax base? Tax base, we said, is the value of an asset or liability for tax purpose. And there is also something I mentioned in our previous class. If an asset qualifies for capital allowance, then the tax base of such an asset is equal to something called the written down value. The written down value is what? The written down value is actually equivalent to net book value, but when computing the written down value, we take the cost of the asset minus these wear and tear charges, or minus this capital allowance. In computing the net book value, we take the cost minus what? Depreciation. Yes. So therefore, what we need to do here, we need to have a column 4, because for us to compute the temporary difference, I hope you can see we need to have a column here for carrying amount. For carrying amount, and we are saying this carrying amount will be the net book value, and our figures will be in thousands of shillings. We also need to have a column for tax base. And this tax base will be the written down value, and also our figures are in thousands of what? Shillings. So the difference between this and this will be the temporary difference. Temporary difference. Sasa? Yes. Let's now compute this. So can you tell me what will be the net book value of our assets at the start of year 1? The net book value. We know how to compute the net book value of an asset. We take the cost of an asset minus its depreciation, minus accumulated depreciation. The cost of our asset was 12 million. I hope you can remember that, 12 million. What is the depreciation for our asset at the end of year 1? Is this one, 3 million. So therefore, the carrying amount here will be 9,000. What about the 2020? 2020, we take the cost, which is the 20, and then we have now today's depreciation for that year, depreciation for this year. Because the asset has been used for 2 years. Or in other terms, you can just take this minus the depreciation for that year only. So which will give us what? Which will give us 6,000. So in year 2021, we take this minus depreciation for that year, which will give us 3,000. In year 4, we take this minus depreciation for that year, which will be 0. At the end of the 4th year, our asset will be fully depreciated. Its net book value at the end of the year will be 0. So then let's compute this tax base. A tax base is equal to the cost minus this wear and tear charges, minus these capital allowances. So for the first year, we are going to take 12 minus this one, which is the capital allowance for that year, the capital allowance or the wear and tear. So that will give us a written down value of what? Which is the tax base. I've said we take the cost minus these wear and tear charges, So in the first year, I'm saying we take 12 minus this, the capital allowance for the first year, which will give us what? 72. Then the second year, we take this minus the wear and tear charge for year 2, which is 36. And I think that will also give us 36. Is that the correct? I've taken this minus this one, just like what you have done here, as far as the computation of net book value is concerned. And then year 3, we take this one minus 24, which will give us what? 12. And then in the last year, we have this minus this, which will give us what? 0, So then what we need to do is to compute the temporary difference. What is temporary difference? Is carrying amount minus tax base. So this minus this. So this will give us what? 1,800, which is a positive figure. Now, who can tell us this particular value here? Is it taxable or deductible temporary difference? Because we have to indicate here whether it is taxable or deductible. Is it taxable or deductible? I hope you can see this one. The carrying amount is more than this one. So this taxable. Actually, we said If you take this minus this, you get a positive figure, is taxable. Is taxable temporary difference. If you get a negative figure, is deductible. So this minus this, which will give us what? 2400, 2400, which is still what? Taxable temporary difference. This minus this, which will give us what? 1800, which is what? Taxable temporary difference. This one will be 0, basically 0. It is neither taxable nor what? Deductible. Now, having that, what do we need to do? We need to prepare now the deferred tax account. Why do we need to prepare the deferred tax account? We need to prepare the deferred tax account, one, for us to be able to determine the deferred tax asset or basically liability at the end of each year, and the amount of deferred tax to be charged in the income statement. That's why you can see in our questions here, the examiner is not specific whether you are computing deferred tax liability or maybe the amount of deferred tax to be charged in the income what? Statement. So let's prepare this particular account here. The account which is called deferred tax account. Deferred tax account. Deferred tax account. And we are going to start with the first year. Remember here we have a number of years. So we are going to start with the first year here, which is 2019. And take into account we have a we have a taxable temporary difference. What are we going to compute here? Are we going to compute a deferred tax asset or a deferred tax liability using the taxable temporary difference? What are we going to compute? Deferred tax asset, deferred tax liability at the end of 2019. Recall, just relate this to what we have done in the other question. The other question for Bawabu, where we had a taxable temporary difference. We have used that taxable temporary difference in computing what? Yes, we use this taxable temporary difference, this one, in computing something called a deferred tax liability. How do we compute that deferred tax liability? We take the taxable temporary difference times the tax rate, times the tax rate. So therefore, let's compute that. And let's compute that. And actually, we can have those workings here. Even before we prepare this, can we compute? Because in the 3 years, we have taxable temporary difference. We need to compute now the deferred tax liability. Deferred tax liability, which will be equal to this one. Taxable temporary difference times what? The tax rate. So we compute this for 2019, 2020, 2021, and 2022. So this one will be equal to the taxable temporary difference, 1800, times the tax rate, 30%. So which will give us what? 540. So here will be this one. Okay, this will be this one. 24 times 30%. So that will give us what? That will give us what? 30% of this, 720. So and then 2021 we have 1800. This one times 30%. Is it coming to 540? And I hope my computation here was there, okay? Was okay. Okay. And then in the last year, we have 0 times 30%, which will give us what? 0, which will give us 0. Yes, which will give us 0. Yes, and I hope these computations here, they are okay. All these computations are okay. Are they okay, all of them? Are they okay, all of them? Okay, sawa. So let's start with this here. So what do we have here? These are deferred tax liability. And actually, these are deferred tax liability at the end of the year. At the end of the year. So being a deferred tax liability at the end of the year, the first thing we need to know here, in the first year, when preparing this account, we don't have an opening balance. So we don't have a deferred tax asset or a deferred tax liability. But recall here, we have said that if, for example, at the start of the year, we had a deferred tax liability, we come and record it here. If we had a deferred tax asset, which can also be another possibility, we record it there as the balance brought down. But in our case, you can see in this question, we don't have a deferred tax asset or a deferred tax liability at the start. So, but now at the end of the year, let's be very keen here. At the end of the year, you can see what we have here. A deferred tax liability. A deferred tax liability, we have said we recorded here. And these are balance carried down of 540. We call all our figures here in thousands of shillings and in thousands of shillings, like that. So we record it on this side. These are deferred tax liability. Then what I've said, remember, first of all, we are dealing with the first year only. We are dealing with this year only. Sasa? Yes. So first of all, ignore the other years. So first of all, we balance the account for that year. And we have said a balancing figure on this side should be taken to the income statement. It is known as a deferred tax expense. A balancing figure on this side is still taken to the income statement, is known as a deferred tax income. A deferred tax income. So I hope you can see the side which is more is this one, 540. 540. It basically means that we have a balancing figure of this on this side, which will be known as a deferred tax what? Expense. A deferred tax expense. Are we together? Now we are done with that here. We are done with 2019. What do we need to do? We need to proceed now to the year 2021. Sorry, the year 2020, not 2021. So we move to the year 2021. Now, we are going to prepare still a deferred tax account. You may decide to separate this account. Now, ufungue account ingine hapa ya 20. Yes, acha tufanye hivyo ndio watu you understand basically what you are doing. But you may decide now to continue with the same account. Instead of preparing the deferred tax account for each year, can we prepare a separate account or just we continue with this one? Which approach are you going to understand? Do we continue with this one or we just prepare another deferred tax account? Let's just continue with this one. Yes, because just the same. Because just the same with opening another account. Now, what do we start with? If now we are preparing a deferred tax account for 2020, what do we start by recording there? Who can tell us? Yes, very, very correct, Wycliffe. So what do we start by recording there is the opening balance. Is the opening balance, because in the previous year we had a closing balance. This balance here, balance carry down, what we do, first of all, we bring it down and actually bring it down on the direct opposite side. So it will be down here. So we say at the start of this year, we have a balance brought down of how much? Of 540. Of 540. That's the first thing we do. And then at the end of this year, we already have a deferred tax liability at the end of the year. How much is it? 720. 720. So what we need to do now, at the end of the year, and maybe for you to understand, remember now here we have like we are through with this account for 2019. Now we are in the year 2020. So whatever you have in 2019, we will not consider it here. That's yes. So at the end of this year, we have balance carried down, and I hope you can see that is also a deferred tax liability. A deferred tax liability here of how much? Of 720. 720. So we balance our account. A balancing fee on this side is a deferred tax expense. A balancing figure on this side would be taken to the income statement. It is a deferred tax income. What do we have? Remember, we are totally ignoring what we have here. We are totally ignoring 2019. We're only dealing with 2020. So we consider the total we have here. Don't consider now what we have up there. Sasa, we are done with that account. So the total on this side is 720, which is actually more. And we have a balancing figure there of how much? Of 180, which is a deferred tax expense. Now we are done with that here. We are done with that here. Now we move to the next year, which now will be 2021. So we bring down our balance here. It will be on this side. So we say the opening balance here is 720. Then at the end of the year, what do we have here? Is 520. is 520. So we have a balance carried down and a balance carried down of what? Of 540. So we balance that account. So a balancing fee on this side is a deferred tax expense. A balancing fee on this side will be taken to the income statement is a deferred tax income. So what do we have in our case? The totals will be 720, 720. So we are going to have a balancing figure here of 180, which is the deferred tax what? Income. So we are done with that here now. We move to the last year. To the last year now here. So which is 2021. In 2021, do we have any balance at the end of the year? No. But even before you do that, let's bring down this balance. Let's not forget bringing down that balance, which is 540. So and then at the end of the year, we don't have any balance of a deferred tax liability. We don't have any balance. So we balance our account. The amount which is more is 520. This side is more. This side is more. We will have our totals there as what? 540. So the balancing figure will be on this side, which basically is will be taken to the income statement. And what is this? This is a deferred tax income. Is the deferred tax what? Income. Is the deferred tax income. So basically that is it. That what was required as far as that particular question is concerned. But equally, remember I said you could have used now the other approach, which is known as the income statement what? Approach. So here what you have done, we have prepared this particular account here using statement of financial position, or basically the balance sheet approach. The balance sheet approach, basically where we have computed the deferred tax using the temporary differences. Using the temporary what? The temporary differences. So basically we are done with that particular question there. And that is it, that what was required there. Now we have another question here. We have another question, which will be our last one. As far as this topic is concerned, I want us to wind up with this topic today. Yes. So there is a question here. So remember, I've said I'll share the solution for part A of that particular question. So but the beauty thing with this particular topic is still a topic you'll be discussing, you'll be covering in AFR. In AFR, once you go to AFR advanced level, so it's a topic you'll still do there. I know majority of the students, I don't know why they complain that these topics are a little bit complex. I've had those particular complaints. Okay, so, but let's do this particular question, which is here. That is a question you'll be able to, but basically try to understand what I'm explaining here. If you understand that, then you'll be in a position to handle any question from this topic comfortably. So we have a question here, which is basically the last one. I want us to do April 2022. Specifically question number 5. Question 5B. 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 And can we just take a breather of 5 minutes? Cindy? Yes, let's just take a breather of 5 minutes and then we come back at exactly 9:35. We continue. A short break of 5 minutes. At least you take maybe a cup of water and then we continue. 5 minutes, we come back at 9:35. Yes, so the question is, Zion Limited, a public limited entity, is in the process of finalizing its financial statement for the year which ended 31st of October 2021. The following information was extracted from its accounting record for the purpose of estimating the deferred tax balance. So we are given that information from note 1 up to note number 7. What are we required to do? we're required to compute the relevant temporary differences. And number 2, we are required to prepare something called a deferred tax account. So we start with Roman 1 of that question, whereby we are required to compute the relevant. We are required to compute the relevant temporary differences. Temporary differences. That is TDs. The relevant temporary differences. Relevant temporary differences. So what you have to recall very fast here is that temporary differences, or the temporary difference, basically is the difference between carrying amount of asset or liabilities. Now, if you go through the information we have in note 1, basically up to note number 6, note number 5, you'll be able to see we are given various items of asset and liabilities. We're also given various information which will help us in terms of computing the year tax base and the year carrying amount. So once we determine those two values, carrying amount and tax base, what do we need to do to get the difference? This is now the temporary difference. And therefore, for us to compute this temporary difference, generally what we do is that we prepare something called a 𝐶𝐬𝐽 of temporary differences. So in this particular 𝐶𝐬𝐽, for computing the relevant, or basically for computing the temporary differences, we have various columns here. The column for assets, various items of asset and liabilities which are given in our question. The next column here will be for carrying amount. The next column should be for the tax base, which is TB. And the last column should be for the temporary difference, because we know to compute this one temporary difference, we take carrying amount minus what? Tax base. Tax base. And also, if you check on the figures we're given in note number 1, note number 6, those figures are given in million of shillings. So also our figures here will be in million of what? Of shillings, will be in million of shillings. Yes, so this one is known as a 𝐶𝐬𝐽 of temporary difference, a 𝐶𝐬𝐽 of a temporary difference. So basically that's how we prepare it for us to be able to compute the relevant temporary differences. Now, I want us to go straight to note 1. Note 1, what are we told in note 1? We are told inventory is stated in the financial statement at the lower of the cost and the net realizable value. So let's be together. Instead of writing, maybe you can just listen, and then you can take a photo, or you can take a screenshot, and maybe transfer this to your book later on. So we are told inventory is stated in the financial statement at the lower of the cost and net realizable value. The company wrote down its inventory by shillings 120 million to a net realizable value of 1130 million. And then you're told the reduction in the value is ignored for a tax purpose until the inventory which is sold. So you're given a lot of stories there, but I want to simplify this for you. So anytime you're given an inventory basically is, is an asset. Now, whenever the company is determining the value for the inventory, the value for the inventory should be determined in accordance with the International Accounting Standard number 2. No worries, we're going to do a subtopic on this. So now the inventory, according to the International Accounting Standard number 2, this one should be valued at the row of two values. At the row of the cost, or Roman 2, the net realizable value. Basically, what that means is that the value at which inventory will be recorded in the statement of financial position should be the row of the two. And actually, that value at which an asset or even a liability is recorded in the statement of financial position is the carrying amount. So the carrying amount for inventory is the row of the two. The row of the two. So what about the tax base? Tax base of the inventory. Tax base for inventory is always equal to the cost. Don't me ask why. You'll be able to understand this better once you do taxation, PFT. So if, for example, you have a business, you have bought inventory. So basically, that inventory you have bought, we refer to it as purchases. So in computing your taxable profit, that purchases is allowable expense. So that's why we say tax base of inventory is always equal to the purchases. Sasa, yes. Now let's go back to that information. That's just what you need to remember. So we are told inventories are stated in the statement, in the financial statement, at the role of the cost and then the net traceable value. And then you're told the company wrote down. To write down is to reduce the value of an asset. Wrote down the inventory by shillings 120 million to a net traceable value of 1130. So what you're given there, 1130 million, this is the net traceable value. And actually we are told in arriving at this, the company reduced the value for inventory by how much? By 120. So that information is given to us so that we can be able to know the cost. So in arriving at this net traceable value, the value for inventory was written down, was reduced by 120. So can we be able to know the cost? Can we be able to know the cost of the inventory? Can you be able to know the cost? Because in arriving at that figure of 1130, the value for inventory was reduced with 120. So what does that mean? It basically means that for us to be able to know the cost, we are going to take this one, 1130 million, and then we add back 120, because in arriving at this, the company deducted 120. So if we add back that 120, we are going to get the cost for that inventory. So what is the cost here? The cost, I'm told, is what? Is 12 what? Is 1250. Is 12 what? 50. Now, having those two values, the net traceable value, the cost, you then need to recall what you have explained here, that the carrying amount should be the lower of the two. So which figure is lower than the other? 1130, 1250. Which figure is lower than the other? Which figure there is lower than the other? It is automatically this one. So this is the carrying amount. Carrying amount is 1130. Tax base. Tax base, we have said, is always equal to the cost. This is the cost. 1250. 1250. So that is just what you need to remember. This concept which I've explained here. This one. If you can be able to remember that, then your life becomes very simple there. So then we get the temporary difference. This minus this. Or basically, yes, we take 1130, we minus 1250. We minus 1250. That will give us automatically 120. But this 120, is it a positive? Is it a negative? Is it a positive? Is it a negative? These are negative. These are negative. So being a negative, it basically means that this temporary difference, this one is deductible temporary difference. Is deductible temporary difference, because you can see this one is less. Is less. Sasa? Yes. So we are done with that particular point number one. Let's move to point number two. So in point number two, we are given trade receivables. We are given trade receivables. And we are told that trade receivables, okay, even before we go through that point, let me explain something here, which will make now our life also very simple there in determining the carrying amount and the tax base, even before we go through that point. So how do you determine the carrying amount? How do you determine the tax base for receivables? And also this applies to payables. These apply to payables. So now, in the carrying amount for these two items, receivables and payables, carrying amount is equal to the net amount. The net amount is what? Just like when we talk about your net salary, is your original salary or your gross salary, and then various items have been deducted. For example, receivables, this one is recorded in the statement of financial position by taking the original value for receivables minus any allowance for doubtful debts. What about the tax base? Tax base is always equal to the gross amount. The gross amount is the original figure. The original figure for receivables or even payables before making any adjustment. Before making any what? Adjustment. Let's go through that point now. We see. We are told the trade receivables had a carrying amount of 450. In our case, we are given carrying amount of 450. And then you're told after making a general provision for doubtful debt of 30. Let's not even go to the last point. So we are told we are given the carrying amount, which is 450. And you're told this is after making a provision for doubtful debt of 30. So we know a provision for doubtful debt. This one, in arriving at this figure, it was deducted. A provision for doubtful debt is money set aside to cater for those debts which are not likely to be paid in what? In the future, which are not likely to be paid in the future. So therefore, this for 50 million, this is the net amount. The company took the original figure for receivables, it deducted 30, it got 450. So what we need to do is to determine the tax base. Tax base in this case, we have said, is the gross, the original figure for receivables. Now, who can tell us what was the original figure for receivables? In arriving at this, the company deducted 30 million. So how do we get at the original figure? The original figure, yes, the original figure, we take 450 plus we add back 30, which was deducted in arriving at this. So that will give us 480. So this minus this, which will give us what? 30, and basically which is a negative, which is a deductible temporary difference. So let's move to the other point, number 3. In number 3, we are given an item of property, plant, and equipment. Property, plant, and equipment. We are told it had a carrying amount. Carrying amount we are given there, that is 50, and a tax base of 27 what? 50. That one we are given. Carrying amount, tax base. And then you're told during the year, this property was revalued upward by 150 million. So that 150 million, this one is known as a revaluation gain. And basically this one, we use it in answering Roman 2. I will be able to explain how we use this in answering Roman 2, but this one will not affect this one. It will not affect the computation of temporary difference. I'll be able to explain that in answering Roman 2. So let's get the difference here. I don't know whether we will be able to completely finish our question here. I feel it may move. We may finish it in our next class. I can see our time is moving very, very fast here. I thought we would be able to finish. So that will be 300. And basically, it is a positive figure. Being a positive figure, what is it? It is a taxable temporary difference. It is a TTD, a taxable temporary difference. So I'll be able to explain when answering Roman 2 how we use that revaluation gain. So let's move to Roman 4. In Roman 4, okay, number 4, we are told, during the year which ended 31st of October 2021, the development expenditure amounting to 480 million was capitalized. Amortization of 20 million was charged to the profit and loss. This development expenditure was allowed for tax purpose in full 2 years ago. 2 years ago. There is something also I need to explain there. You need to know in relation to development expenditure. In relation to development expenditure. Development expenditure. What is development expenditure? Development expenditure, basically, this is an expense which is incurred by the company, or expenditure incurred by the company whenever the company is doing what? Whenever the company is developing a new product. A company may be coming up with a new product, so automatically the company needs to do some research on how to manufacture that new product. The company needs to do market testing, whether maybe the product is acceptable in the market and so on. So the company will incur so many costs. Now, these costs, which are incurred by the company in developing a new product, then this particular expenditure should be accounted for in accordance with IS 38. Now, International Accounting Standard number 38 requires that this particular expenditure should be capitalized. Should be what? Capitalized. What do you mean by capitalizing an expense? Capitalizing an expense means that this particular expense, you will not deduct it from the, or the company should not deduct it from the total incomes, in doing what? In computing the profit or loss for that year, but this is accounted for as an asset. Is accounted for as an asset and then amortized. Amortized means that it should be gradually written off. The company should determine the number of years this particular expenditure will be written off. Sasa, yes. Now, how do we determine the tax base? How do we determine the carrying amount of such an asset? which arises as a result of an expense being capitalized. So we come and we write it here as a development expenditure. Development expenditure. In some cases, this can also be known as intangible assets. Intangible assets, an intangible asset which occurred as a result of capitalization of an expenditure. Now, in this case, how do we determine the carrying amount? The carrying amount is equal to the cost or the expenditure minus amortization, minus accumulated amortization. What about the tax base? Tax base, in this case, this one you have to get it very clear, is equal to amount allowable for tax purpose in future. For tax purpose in what? Allowable for tax purpose in future. In most of the questions, you will come across in relation to development expenditure or any other expenditure which has been capitalized. In most of the cases, you'll be told by the examiner that either the cost was allowed for tax purpose in full during the current year or in the past. It was allowed for tax purpose during the current year or in the past. So if the company has incurred, for example, an expenditure of like 200 million, and you're told that this has already been treated as allowable expense, like during the current year or in the past. So then you need to ask yourself, will the taxman allow the company to account for this expenditure as allowable expense again in the future? It is obvious no. So if you have a business and maybe you have incurred an expense of 200 million, you have already offset that against your incomes in computing the taxable profit in a certain year. It is obvious that the taxman will not allow you to do what? To treat this expenditure again as allowable expense in the future, because you want to reduce the taxes you're going to pay to the taxman. So if you're told the expenditure has already been allowed for tax purpose in the future, either during the current year or in the past, then its tax base is always equal to 0, because that is the amount which will be allowable for tax purpose in the future. In other terms, the taxman will not allow the company to treat this expenditure as allowable expense again in what? In the future. It has already been accounted for as allowable expense during the current year or in the past. So let's go back to that point, having understood that. So we are told during the year, the development expenditure amounted to 480 was capitalized, and then you're told amortization was 20. So amortization is to help us to get the carrying amount, because you're given the cost or the expenditure was for 80, amortization 20. So that will give us the carrying amount. Carrying amount in this case will be for 60, which is equal to the cost minus amortization. And then in the last sentence, we are told the development expenditure was allowed for tax purpose in full during the year. In full during the year. Then we need to ask ourselves, how much amount will be allowable for tax purpose as far as this expense is concerned in the future? It is obviously 0, simply because it was accounted for. It was treated as allowable expense during the current year, the full amount of 480. Will the taxman allow the company to treat this as allowable expense again in the future? No. So the amount allowable for tax purpose in relation to this in the future, therefore, will be what? Will be 0. Will be what? 0. So we get the difference here, which is 460, and that is TTD, taxable temporary difference. So let's do the last one. I can see our time is almost getting over. So it basically means that we're going to finish the second part in our next class. So in note number 5, we are told the trade and other payables. Let's just write that here. Trade and other payables. Are carried at 600 million. Carried, that is their carrying amount. They are carried at 600 million. Carried at 600 million. And then you're told included in other payables are accrued expenses of 100 million, whose related expense are deductible for tax purpose on cash basis. What does that mean? It basically means that this particular amount here of 600 million, it basically include 100 million or an expense of 100 million, which is treated or which is deductible for tax purpose on cash basis. So this one will be treated in very simple terms. It means that this will be treated as allowable expense once it has been paid. Once it has been paid. Now, who can tell us this particular amount, which is included as part of the payables, has it been paid or not? And recall liabilities. Sorry, recall payables are liabilities. Payables is what the company has to pay. So this amount of 100 million, which is included here, has it been paid or not? Has it been paid or not? It is not yet paid. And that's why it is part of the payables. Payables is what the company is to pay in the future. So we are told that this one will only be treated as a allowable expense once it has been paid. And because it has not been paid, it basically means that during the current year, it was not treated as a allowable expense. So therefore, how do we get the tax base for this? We are going to take this particular amount here, but now we exclude this one because this one is not allowable. It will not be taken into account in computing the taxable profit. Be less it is disallowable. So be less it. So meaning that here we are going to get what? 500. We are going to get 500. Then the other thing which is also very, very important here to note is that what we have in note 1 here is basically an asset. Receivables is an asset. PP is an asset. This development expenditure which has been capitalized and treated as an intangible asset is an asset. But now what we have here, payables, these are liability. And therefore, when recording liabilities here, because by the end of the day, we are going to come and we add all these figures, we get a net amount of temporary difference. When recording a liability here, what do we do? When recording a liability, we record both figures as negatives because these are a liability. But for assets, record all the figures as positive. Are we together? Yes. So now, how do we compute this one? To compute this, we take our figure here, our tax base, our carrying amount, sorry. Our carrying amount is negative 600. Negative 600. And then we minus the tax base. Our tax base is negative 500. I hope you have seen what I've done. I've taken our carrying amount, negative 600, minus negative 500. So this will give us minus 600. A negative and a negative is a positive 500. So this will give us negative 100. So this is negative 100, and which is deductible temporary difference. So basically we are done because what you're given in note number 6 is about the deferred tax liability at the start. Number 7, we have the tax rate. So what we do, because here we have various items of asset and liabilities, we don't work with the individual temporary difference or the temporary difference for individual asset, but we have to get the net amount here. So add up for me all this. You give me the total. Give me the total. Give me the net amount here. I'm given a figure of 510. And actually, because that is a positive figure, we refer to that as net taxable temporary difference. Net taxable temporary difference. Net taxable temporary difference. And automatically, this one, we are going to use it in computing the deferred tax liability. But because our time is over, I think what we will do once we meet in our next class, God willing, next class, I want us to start on a very, very important topic. Very important topic. Important why? Because these are compulsory topic in the exam. So even the exam you'll be sitting for in December, you'll come across this particular topic here, the topic of published financial statements. But before we start on this topic here, we will take like the first 10 minutes to finish on what is remaining as far as that question is concerned, Roman 2, whereby we are required to prepare the deferred tax account. But even before we do that, you can attempt, because you can see, you will do whatever we did in that question for Bawabu. First of all, record the deferred tax liability given in note number 6. Compute the deferred tax liability at the end of the day using this net taxable temporary difference. But there is something we will do as far as note number 3 is concerned, in relation to that revaluation gain. That I think is just what I will explain. That recording opening balance, closing balance, and then balancing that account is concerned. So I think we will just take like the first 10 minutes. In our next session, we finish on what is remaining in that question, and then we move to this topic, which is the published financial statement, which I'm saying is a topic we can't afford to miss. Sasa, yes. So for today, I want us to stop at that point, and I hope you have learned something today. I hope you have learned something today. Sasa.